Where are you going to get the best revenue and where are you going to get the profitability? Because for the first time in a long time that I've been talking to you, you're fully licensed up just about in China right now. You got full ownership of the mutual fund venture earlier this year. The securities unit got 100% ownership in 2021. The futures unit in 2020. You're fully licensed up, so I'm not going to pepper you with those kind of questions anymore. When are you going to get that full ownership and the like? But the question shifts to when are you going to get break even in some of those units? Securities did better than most banks last year, but it's a different environment this year.
Yeah, look, I just named a few examples, right? Yeah, you're totally right. We now got all the full licenses. So now it's really getting to work moment. But, well, first to disclaim, we are pretty objective in a heightened risk scenario. So we will adjust our portfolio subject to the cycle. And we've seen a lot of cycles. A property cycle lasts 18 months, and we navigated it well. So my point is we stay business as usual. We look at the risk parameter, and then we scale. So looking at this, right, you can absolutely see it's a China, but not just China phenomenon in the global equity capital markets. We are seeing a contraction of the IPO volumes out there, but at the same time, there's still a healthy volume onshore. You look at some part of it, A-shares is still a big part. If you add all the Greater China, or let's say Hong Kong, China position together, there's still volume, but you got to be onshore to participate. And it will be a longer journey than we would wish to gradually build up scale and reputation to do good businesses, but we're invested and we're going there, we're progressing well. Now, I think we look at cross-border a lot. That remains a theme. So when we look at competitive edges, like us versus local competitors and foreign competitors, we still feel strongly that we have the best global platform in 100+ countries around the world to serve our clients. And Mark, that is phenomenal. And so going the cross-border as the differentiator is the key.
The inevitable question, though, is, is it a bit, given the circumstances now, overinvestment that has been made by JPMorgan, and where will the cost cutting come from? We know all the big banks are embarking on multiple rounds of job cuts. Sources have told us that the 30 investment bankers in the Greater China area were cut by JPMorgan. Another round could be coming. Where are you tightening the belt? Will there be job cuts?
Look, I think it's a general healthy approach to upgrade. It's an annual process that everyone does in all businesses. When you look at the situation, there is a clear wallet adjustment in equity capital markets and in investment banking, and it's like a global phenomenon, not just a China one. But when you look at the secular element of China's, you have urbanization, you have industry platonic shifts, our steady growth in headcount, revenue, active clients are still here. And as I said earlier, when I met clients in Europe and the mean and the median still points to a growth. Now, I have to admit that there is a potential sampling bias. But it's also true that when we're banking with the top echelon of the clientele, they are still seeing this as a critical market, and in fact, they are still forecasting revenue growth. So we hope to continue this, which is serving with our clients, and we're still expecting growth this year overall. So that side will be a rebalancing into some of these cross-border corridors, commercial banking, asset-backed securities, and in markets, in capital markets. So I think we are seeing a growth here, and I hope it continues. But even on a down cycle, we will find a way to navigate with it. But we are always risk vigilant on looking at where we commit capital.